Never ever would I have expected to see Google, Amazon, Facebook all absolutely collapse after earnings after seeing record after record breaking profits year after year. Now, this earnings season has left many companies in shambles, but a good investor knows this is the best time to buy companies on a steep discount. Today we will cover 3 fabulous stocks, both dividend and non-dividend. The first company at a steal at these prices is Google. Google is a vastly overpowered technology company that boasts its stellar search engine. This search engine, it only tracks you and censors your search results, but it's still the best out there. Its algorithm is so powerful that ads will somehow know what you want to buy from that private conversation you had with your friend last week. Google makes money from its AdSense program. Whenever users click on an ad, a company paid for that spot. I don't need to tell you that Google also owns YouTube. I mean, I didn't need to tell you, but I still told you anyway. Google is essentially digital real estate, offering services such as Google Maps, Google Play Store, Android, Google Chrome. This is how they're able to generate around $69 billion every quarter. Now that's nice. But Google's latest earnings did not impress investors. Google increased their revenue, but fell short of expectations, and earnings per share declined considerably from last year. Google is down nearly 40% year to date, and well below its 200-day moving average of 119. So is Google finally dead? Is DuckDuckGo gonna take over? Hell no, guys. Google is an advertising company. It makes money because companies' marketing departments want to get their products and services out there, and they invest in Google ads so they hopefully will sell more products and services. Now, whether any politicians or media, whether they want to admit it or not, we are in a recessionary period. Not only are consumers not going out and spending as much money as they did before, but companies are also going to be making massive cuts, and that includes to its marketing department. Their marketing budget won't be as much. This is all short-term friction though, as Google's core products are still intact. They still are offering the same goods and services that they were when times were good. Companies might be putting less money into Google Ads today, but that doesn't mean they will tomorrow. And Google Search, it will be right there and listening to your conversations, as they essentially have a monopoly with search engines. This is your chance to get a company that has consistently grown its revenues over the decades. A company that has $125 billion in cash on its balance sheet, ready to make more acquisitions, invest into its own company, have more share buybacks, or maybe just one day they will pay a dividend. I currently own almost 28 shares of Google, making up about 2.6% of my portfolio. Okay, I had to DuckDuckGo my next stock that's a buy, and that is Union Pacific, ticker symbol UNP. Dividend lovers will love this company. Google might have a monopoly on internet search, while UNP has an oligopoly with US railway networks. Existing since 1862, when President Lincoln wanted to build a rail line west from the Missouri River, UNP connects supply chain solutions to 23 different states in the western two-thirds of the US. This company also connects to Canada's rail system and to all 6 major Mexico gateways. Trains nowadays are longer than ever, they're fuel efficient, and they're super reliable to transport products. Trains are essential for everyday services for things like moving coal, fibers, drugs, soaps, plastics, construction equipment, food, grain for farming, car parts, and so many others. A world without trains would not be very pretty. It's almost as bad as a world with 8% inflation. You can ship just about anything using rail, and you can bet no competitors are coming into this market, as it has really high barriers to entry, as it's very hard to just build railroad lines these days. An oligopoly is when market share is controlled by just a few competitors, and they offer essentially the same service. That's just another reason why this company is so safe, and so is that dividend. Union Pacific has a payout ratio of just 44%. They've raised their dividend for over 15 years consecutively, and they have a 5-year CAGR of 15%. That is amazing. Just imagine getting a 15% pay raise from your job every year. This is a company that has aggressively bought back shares as well, having over 1 billion shares outstanding a decade ago to just 614 million shares outstanding today, and they continue to decrease that each quarter. You love to see it. Honestly, this is a no-brainer for me. This is why I own 12 shares of Union Pacific and get paid $63 every year, and that's only growing because I know this company is going to keep raising their dividend. The next company to keep an eye on is Devon Energy, an energy company that boasts a 6.1% starting dividend yield. Devon is one of the leaders in oil and natural gas exploration and production in the United States. And yeah, I know it looks like it's pronounced Devon, but it really is Devon. Its estimated daily production is 300,000 barrels of oil, 125,000 barrels of natural gas, and 920 million cubic feet of natural gas. These are all, of course, essential for everyday products we need, and that's why the company is able to produce consistent cash flows. They brought in $13 billion in revenues last year. Now, when we look at Devon's dividend history, this company has been paying dividends every quarter for decades. However, I've never seen a company as spotty as Devon. They have a variable dividend cash return strategy. This is where the company tries to pay out 50% of its excess cash flows as a dividend to you, the shareholder. Hopefully, I haven't lost you yet. So here's what happens. The company, they pay out a normal quarterly dividend, which is typically the fixed type that you are used to. But they make an additional variable one at 50% of its free cash flows. Honestly, this is the epitome of shareholders actually getting to enjoy the profits of a company. Just know that oil prices fluctuate very heavily, so gas prices, they will rise and fall, and so will that variable dividend payment. The company actually made 8 different dividend payments last year. Devon's latest earnings were quite optimistic as they expect 8% growth, a 40% return on capital, access to some of the most rich basins in the United States, and they have a track record of improving efficiencies and lowering the cost of supply. Oil prices currently are actually artificially lower than they should be, in part because of Uncle Joey using strategic oil reserves to lower prices ahead of the midterm elections. But that's definitely not a sustainable strategy, so expect oil prices to come back up after the midterms, meaning more money for Devon. Oh, and by the way, not only does Devon pay an amazing dividend, but Devon has absolutely dominated the stock market this year, up almost 90%. Keep in mind the S&P 500 is down nearly 20%, so that means there's a 110% swing in performance. Marvelous, simply marvelous performance by Devon. All right, investors, that's 3 fabulous stocks that are certainly intriguing at these prices. They offer some gigantic dividends. Some pay dividends twice a month. Some are total monopolies. Some are oligopolies. But either way, all these companies should allow investors to grow their wealth over time. Make sure you hit that like button and subscribe to the channel. It's the best way you can support this small-time creator. My videos are always found in podcast form under the Collect Cash podcast name, and I will buy, stash, and collect cash you later.